Just as we did with the finance lease liabilities, let us move on to the operating leases. So for the operating lease liability, let us bring in the ending balance for the total operating lease liabilities. In this case, we will go to the row at the top to the operating lease information. We grab the annual closing balance. We can fill that right. We can also bring in the current portion of operating lease liabilities. We go again to the row at the top and we grab the current portion. We can switch the sign to make that negative. We can fill that right. Now we can get the ending balance for the long-term operating lease liabilities, so we can also that and fill that to the right. So operating leases was only brought to the balance sheet in the year 2029 for US cap companies. Prior to that, operating leases followed the income statement approach to operating lease accounting. So now, let us begin forecasting the operating lease liabilities. So we will begin with the existing lease liabilities and then we will get into the new lease liabilities for the operating leases. So in this case, the beginning balance is going to be a corkscrew calculation. It's going to be the ending balance of the previous period after taking into account the current portion of the operating leases. So in order to calculate the interest, it's going to be based on an opening balance. So it's going to be based on opening balance. But before we do that, let us go to the control panel tab and let us make sure that we have the net additions as a percentage of revenue. We have to bring in the interest rate on leases. We also have to bring in the weighted average remaining lease term for existing operating leases, and we also have to bring in the lease term for new leases for the operating lease. So let us begin with the net additions. The net additions, we had that on the row at the top, which we summarized a while ago here. So we can bring in the net additions for operating leases, 3.5%. We can bring in the interest rate. We can go to the row at the top. We can go the weighted average discount rate for the most recent year of 2.5%. So this is the incremental borrow rate, 2.5%. We can also grab the weighted average remaining lease term for the existing leases. Still found on the row at the top. So the weighted average remaining lease term for the most recent year is 11.3 years. We can grab that. Also, we can set an assumption year for new leases going forward for 15 years. So having done that, we can switch back to our financial statement under the supporting schedules where we have this operating lease liability, and we begin to model the interest and the principal repayment of the lease liability. So in order to model the interest, it's going to be equal to, we take the beginning balance and we multiply that by We go to the control panel tab and we grab the incremental borrowing rate, that is the interest rate. We grab that here of 2.5% pre-tax cost of debt. So we have a place we can. And then, just as we did for the finance lease liabilities, the lease payments on existing lease liability is gonna be based on the interest, that is the incremental the interest and the principal repayment. So we are essentially saying that it is the total debt service for the operating lease. So the total debt service for the operating lease takes into consideration the interest and the principal repayment. So in this case, the lease payment is going to be the total sum of the principal and the interest. So we have to calculate the principal repayment here while including the interest. So in order to do that, we're going to set the formula to be equal to an if statement. So we'll say if the opening balance, which we have to reference with F4, if we have to pay that, we have to divide that by, we go to the control panel tab by the weighted average remaining lease term for the existing leases of 11.3 years. So if that, we switch back to, so if that is less than the beginning balance,